Starting with the second part of the introduction. So we ended over here, measurement principles. So just have a first recap of the things which we studied. So we did the introduction one, that is the FACS and the boards. We studied the boards and when AICPA formed. This one is important one, codification structure. First comes area, and under area there are topics. Under topics there are subtopics. Under subtopics there are sections, then subsections, then paragraphs. Then we went through all these things. Basis of US GAAP and accounting assumptions. There are 4 accounting assumptions. One is entity assumptions, going concern assumption, time period assumption. The other one is unit measurement assumptions. So the assumptions are 4. EGTU. That is, we will remember this EGTU, that is entity assumption, G for going concern assumption, T for time period assumption, and U for unit measurement assumption. So we studied the capital maintenance. The financial capital maintenance is considered under US GAAP. Financial one is considered under US GAAP, and the physical capital maintenance is not considered under US GAAP. And the accounting principle, there are 4 accounting principles: measurement principles, revenue recognition principle, expense recognition principle, and full disclosure principle. And under the measurement principle, we studied how the costs are measured, that is historical cost, net present value, net realizable cost, current replacement cost, fair value, amortization cost. So last class we ended over here. So from today we are going to study this other consideration. Under other consideration we have cost constraint and conservatism. Cost constraints means we have limitations on cost, that is a company always have limitations on cost. If a company is going to buy something, so the company will verify it from other sellers and will pick up the seller which is suitable, means which satisfies the cost with no compromising the quality. So one is cost constraint. So a company always have cost constraint, always have to minimize its cost. And the other one is conservatism. Conservatism is also known as prudence. Prudence or conservatism are both the same. Conservatism stands for whenever there is an expense, we need to record the expense first, and whenever there is a future expense, means we know that there is a future expense which is going to happen, so we are going to record the expense. But if we know that there is a probability that revenue is going to happen next year, then we are not going to record that revenue. So this is the method of conservatism, means if we see a future expense, we will record it. If we see a future revenue, we will not record it. And speaking of this revenue, we will study in detail in the revenue recognition chapter. There are certain conditions. If those conditions are satisfied, then only we will record the revenue. But there is no conditions for recording expense. If we see a future expense, we will record the future expense straight away. Recognition and measurement criteria. So there are definition, measurability, relevance, faithful representation. We will study all in detail. Elements of financial statements. What are the elements of financial statements? Assets, liabilities, equities. These two, investment by owner and distribution to owner. These are very important. Investment by owner. What does it mean? Investment by owner. Investment by owner means the owners are investing to the company. So in the company's book, we will see that the company has recorded that due to owner. Investment by owner means due to owner. It is the liability of the company to pay the owners back. And distribution to owner means the company has distributed the money to owners, so it is the liability of the owners to repay the money back. So in the book of the company we will see that due from owner. So when it says that investment by owners, so in the company's book we will see due to owners, and over here distribution to owners means due from owners in the books. But in the financial statement we will see that investment by owners, that is the owners have invested, so the company has to repay them back. And this one says that distribution to owners means the company has distributed the amounts or the funds to the owner, so the owner's liability arises that they have to repay the money or funds back to the company. So this one, investment by owners, we will see in the books as due to owners, and distribution to owners we will see in books due from owners. Gains, then we will see gains, losses, comprehensive income, revenues, expense. Comprehensive income we will study in detail. Cash flow information and present value in accounting measurement. When to use? Non-availability of fair value. When the fair value is not available, then we will use measurement areas like initial recognition and fresh start measurement. Initial recognition is the first time measurement, and fresh start measurement is just after the initial recognition. Components of present value measurement. What are the components of present value measurement? The future cash flow estimation, variations in timing or amount of such cash flow, time value of money approach considered by risk-free rate of interest, risk and uncertainty regarding prices of assets or liability, other relevant factors. You don't have to remember all these things, just see once and we will solve the questions later on. Approaches for present value computation. What are the approaches or calculation we will do to figure out present value computation? The traditional approach and the expected cash flow approach. In the traditional approach we use the discounted cash flow approach, which uses single rate discount factor mainly for single cash flow, and the expected cash flow approach we uses risk-free rate of discount, that is the weighted average of all the expected cash flow. In the later stage, whenever there will be MCQ, so we will solve each and every questions in detail, but since this is a first revision video I cannot go in deep, but still I will focus on covering all the aspects because my notes is quite very comprehensive, and I will also follow the other publications book in my future lectures. So going forward to fair valuation, definitions of fair valuation. Definition of fair value: price that would be received to sell an asset or paid to transfer a liability in an orderly arm's length transaction between market participants at measurement date. That is, fair value is the price which is received to sell an asset or paid to transfer a liability. It is the exit price, means we are going to sell a asset, so what is the amount which we are going to receive in lieu of that selling the asset. Approach to determine fair value. What are the approaches to determine fair value? We have principal market, that is the greatest volume of maximum level of activities. That principal market is the market where the buyer and seller, it's like a market where they bid our asset. So with regard to the market, we will prioritize which one we should take, that is the highest bidder we will sell to that seller, the seller who will give the highest bid. Then most advantageous market, used when principal market is not available. in certain countries or in certain cases it may happen that our product is not readily sellable to the principal market. Then we use the most advantageous market, that is it can be some chemical which is not easily sellable to the market, so we will use the most advantageous market. We will maximize the amount received for asset or minimize the amount paid to transfer liability. Either we will maximize the amount received for asset or we will minimize the liability. Other points for most advantageous market is considered when stock is equally exchanged on both markets. NRV is to be considered. Select valuation premise. Assume highest and best use. So when the asset is in use, then we will provide maximum value through use with other asset as group, or when we are going to exchange some asset, then we will provide maximum value on standalone basis. Selection of valuation technique. Change in technique is considered as changes in accounting estimate. That is, whenever the question says that the company has changed its technique, so it is deemed that the company has changed its accounting estimate. Then market approach. Market approach is the most reliable approach which is used to derive information through market forces. Then we have income approach. Income approach is more reliable than cost approach, but it is less reliable than market approach. So it is in the between. That means it is less reliable than this market approach, but it is more reliable than cost approach. And cost approach is the least reliable. So if in CPA question, if they ask that which is the least reliable approach of measuring an asset, we will say that it's the cost approach. So what are the inputs for fair valuation? Fair value valuation. So how do we calculate fair value valuations? That is level 1, quoted price. Quoted price. We quote some price from activities like assets and liabilities, which is the most reliable market approach. Level 2, you don't have to remember this level, but it's just for your knowledge purpose. These are just basic introduction which you should know while appearing your CPA exams. Level 2 is observable inputs, that is certain adjustment to level 1 inputs. The level 1 inputs are the basic inputs and we just have an add-on, that is the level 2 adjustment, and the level 3 are unobservable inputs which we cannot observe. That is, it is based on equity's own assumption. It is the least reliable cost approach. Then we have financial statements under US GAAP. Full set of financial statements. It includes, we can have a question that what are in a financial statement, what do we have in financial statement, or prepare a full set of financial statement. We can have a simulation and we will have multiple options and we have to choose them, forming the set of financial statements. So financial statements include balance sheet. First we will have balance sheet, then income statement, going forward with statement of comprehensive income, statement of cash flow, statement of shareholders equity, and finally notes to financial statements. So we have 6. The 3 are easy, we can remember: balance sheet, income statement, cash flow, and then we have other new 3 things, that is statement of comprehensive income, statement of shareholders equity, and notes to accounts. So we have 6 things. One is balance sheet, second one is income statement, third one goes with this income statement, that is statement of comprehensive income or statement of cash flow. You can see, you can just, there is no sequence, but when we prepare like annual reports, we follow this statement. So this statement is not this sequence, remembering this sequence is not important for your CPA exam, but it's important for your practical life. So we generally what we do is first we keep balance sheet, then income statement, then comprehensive statement of comprehensive income, then statement of cash flow, then statement of shareholders equity, then notes to financial statements. So what do we have? We will study each and everything in detail. So this is my notes. I have prepared it. I don't know how you are liking my lectures. I may go slow, I may pause sometimes because it's my new thing, but I am just doing for you all's benefit. There is no monetary benefit. I am just spending my time because I know there are some students who cannot afford spending 1 lakh, 2 lakhs for their coaching fees, for their tuition fees. So I took this initiative. I made these comprehensive notes. I will give my full efforts and I will make it sure that studying my lectures, there are some people or those whosoever follows my whole lecture, I will make it sure that they clear CPA with flying colors and make their parents proud. So I just need nothing, just press a like if you like the lectures and pass a comment saying what are the places where I need improvement. So balance sheet, statement of financial. In India we say balance sheet, but in USA they don't understand balance sheet, they say statement of financial positions. Balance sheet is known as statement of financial positions in USA. So it is what is balance sheet actually? It is all the assets and liability on a particular date and a particular point of time. That is, we say generally balance sheet as on 31st December 2024. So we are saying that balance sheet is on a particular date. Total assets, this is very important. Total assets, how can we denote total asset? Total asset is equal to the total liability plus owner's equity. Basically students make a mistake, they say total asset is equal to total liability. No, total asset is not equal to total liability. Total asset is equal to total liability plus owner's equity. Or we can also say total asset is equal to non-current asset plus current asset. This is the full means debit side and credit side, and this is we are bifurcating the debit side only. Total asset is equal to total non-current asset plus total current asset. Total liability, how do we calculate the credit side or bifurcate the credit side? Total liability is equal to non-current liability plus current liability. Current, what do you mean by current asset? Now this is very basic, but I still wrote this in my lectures because I cleared the basic concept first and then I moved to the in-depth knowledge. What is current asset? Current asset can be derived in two ways. That is, it is basically assets which can be realized in cash within 12 months or normal operating cycle. We just have to know these two things: normal operating cycle or which can be realized within 1 year. 1 year of balance sheet date. That is, current asset can be current asset and current liability are the same. That is, current asset can be realized within 1 year or within normal operating cycle. What do you mean by normal operating cycle? In some projects, in some big projects like making of a bridge or making of a flyover, we have operating cycle of 36 months or 4 years, 5 years. So if it's get sold or realized in cash within that 4 years or within that 36 months, then it will be categorized as current asset. So it's the operating cycle of different industries. If for farming industry the operating cycle is 2 to 3 months. So if it can be sold within 3 months, we will categorize as current asset, and if the farming material or the farming goods is realized after 3 years, then we will categorize that as non-current asset. So that is for operating cycle. So what do we mean by non-current asset? The asset which is not a current asset will be categorized as non-current asset automatically. So current liability is also same as current asset. Liabilities that are due in upcoming year or in the operating cycle, that are due in the upcoming year or in the operating cycle, is the current liability. Upcoming year means within 1 year, and liability will be made through the transfer of current asset or criteria of another current liability, and liabilities which will be made through the transfer of current asset or creation of another current liability are known as current liability. So what are non-current liabilities? Non-current liabilities are the liabilities which are not current liabilities, are non-current liabilities. We have definition for current asset and current liabilities, and which are not current, they are automatically transferred to non-current. So owner's equity. So what is owner's equity? Owner's equity are not a resource or obligation. It's mainly contributed capital by the owners and retained earnings. Retained earnings is transferred from the PL or the income statement. Different accounts used for valuation purpose. One is contra account. Contra account means from cash book to passbook and from passbook to cash book. These are the contra accounts, or from one account to transfer to another account, or from one bank checking account to credit card account. These are the contra. And the adjunct accounts. Adjunct account means the same effect to the associated account. Means we have, for example, a company has 4 partners. So partner A, partner B, partner C, partner D. So all the partnership accounts will be known as adjunct account, because all the treatment will be same. And the other one is valuation account. Account used to increase or decrease value to market value. What are the miscellaneous terms? Liquidation value. What does liquidation means? At the time of sale, when the company is being sold, then the assets and liabilities will be considered at liquidation value. At the time of selling, the liquidation value is calculated. What is market capitalization? Market capitalization means the total value of the firm's outstanding stock. Outstanding stock means the stock which the company is having or holding. What is accounting cycle? Step 1, pass necessary journal entries. The accounting cycle means from transactions to preparation of report. This is the accounting cycle. How does accounting start? Accounting starts from a transaction. The transactions can be either buying or selling. So if a person buys a thing, then it's known as transaction. After transactions, we need to pass journal entry. After journal entry, we need to post it in ledger, and from ledger we need to prepare trial balance. From trial balance, we need to record the adjusting journal entries at the month end or year end. And then we need to repeat step 2, that is, we need to post the associated journal ledgers, general ledgers. Means from journal entries again we need to post in ledger, and then after ledger we need to prepare adjusted trial balance sheet. Then we need to record closing entries and post them. Then prepare of trial balance. Then from trial balance we need to prepare income statement. From income statement we need to prepare balance sheet, and again balance sheet, then other statements, other comprehensive income statement, then cash flow, then it will go on. Finally we will have to prepare reports. Then income statement and statement of comprehensive income. Income statement. Income statement is also known as profit and loss account. In India we say in PL, profit and loss account, and in USA they say income statement. So income statement is also known as statement of earnings. So statement of earning mainly consists of income from continuing operation. There are two parts: income from continuing operation and income from discontinuing operation. Income from continuing operation we show it in income statement, and we show separately income from discontinuing operation. We will study it later. So this is just the basic introduction lecture. We are just understanding the terms. So income statement consists of mainly consists of continuing operation. It is for entire period, measures the performance of particular accounting period. Other comprehensive income mainly consists of unrealized gains or losses, and includes foreign currency translation adjustment. We will see in later that what does foreign currency translation adjustment means, but for general purpose I am saying that foreign currency translation adjustment records the fluctuation difference of a foreign currency. Means I bought a material in $100 and I have my headquarters of company in India. So I purchased a material for $100, and after 1 year that $100 value in INR have increased. So that profit I will record it in foreign currency translation adjustment account. And if there is a loss, if the value has reduced, then I will record a loss in foreign currency translation adjustment. And after that we will study unrealized holding gains and losses on securities available for sale, pension and other post retirement benefit plan, deferred derivative gains and losses. What do we mean by comprehensive income? Comprehensive income means net income plus other comprehensive income is equal to comprehensive income. So types of accounts, types of incomes. Types of incomes is categorized into two terms: accounting income and economic income. How do we derive accounting income? Accounting income is simple: revenue less expenses equal to accounting income or gains. Means accounting gains or losses. It's simple: sale minus cost, or revenue less expenses less loss if there are any, or add gains. Means this revenue and expenses is from trading account, and this in losses and gains is from income statement, that is PL account. This is trading revenue less expense. This is profit and loss or income statement losses, add gains. Then we come to accounting income. So accounting income means revenue less expense of trading account and gains less losses from profit and loss or income statement. And economic, then we have economic income. Economic income is the difference in fair value of net asset during a particular accounting period, or it can be said as it is affected by income earned during the year, any capital contributed less dividend paid and treasury stock transactions. So we have opening balances, FV of net asset as of opening date. Then we need to add net income during the year, add capital contribution by the owners, less dividend paid, less treasury stock. Treasury stock is also a part of the owner's stock. So we need to deduct the treasury stock. So its opening balances will be the fair value of the net asset, add net income, add capital contribution, less dividend, less treasury stock. Then we will have the closing balance. Okay. Then moving forward to format of statement of earning. Income from continuing operation. Income from continuing operation can be calculated in two steps: single format, multi-step format. Single format has only one column, multi-step format have two or more columns. This is a sample of single step format. This is revenue, sales revenue, interest revenue. We will add all the revenues, we will get total revenues, and we will deduct all the losses or expenses, and we will come to the net income. This incomes consist of both trading income and income statements income, and this losses consist of both trading account cost and profit and loss cost. That is, cost of goods sold is a part of trading account, commission expense, office supplies is a part of commission expense, can be part of both trading account and PL account, but it's mainly of trading account. Office supply expense, other than factory expenses, all are categorized under profit and loss. So office supply expense is of PL, profit and loss expense account, and all the subtracting all the expenses we come to net income. And as I said that multi-step format has two or more columns, but we generally in CPA exam we use two columns: sales less sales discount and all the sales return. We will come to gross margin, and then we will deduct all the expenses. We will come to income from operations, and then we will deduct all the interest expenses. We will come to profit before interest and tax, and then we will deduct the tax, and then profit after tax. Extraordinary items. What are extraordinary items? Which are unusual or which are infrequent items which do not occur in ordinary phase of business. That is, no special category prescribed in statement of earning, included in the part of continuing operations, or disclosed in notes to financial statements. Other comprehensive income stands for other comprehensive income we have disclosure method, that is in single statement of comprehensive income or separate statement of income statement and other comprehensive income. OCI items are we are just moving forward. OCI item we will study all this later. So coming to the summarized charts of net income and other comprehensive income. Comprehensive income, net income, income from continuing operation. Comprehensive income is divided into two parts: net income and other comprehensive income. Net income comes from continuing operation, that is net income from PL, and from PL we transfer it to balance sheet as transfer to retained earning, and transfer to retained earning in balance sheet is showed under equity section. And for other comprehensive income, we transfer it to balance sheet as income transferred to accumulated OCI, and that is also under equity section. So coming to accumulated OCI, other comprehensive income, appearing in balance sheet, statement of owner's equity as footnotes. We have to show as footnotes this other comprehensive income. And individual accumulated balances of each component of OCI needs to be reported. That each of the individual accumulated balances of each component of OCI needs to be reported. You just learn this because these kinds of questions can also be come under MCQs. You have to find the right one out. We do not report the aggregate accumulated balance, we report the individual accumulated balance of each component in OCI. Statements of changes in equity. This statement of changes in equity is also known as statement of changes in owner's equity, or statement of owner's equity, or owner's equity statement, or statement of shareholders equity. So this can be said in many ways. It displays changes occurred in equity portion of balance sheet in current year by comparing beginning balances and ending balances of every component of equity with description of reasons of such changes. We will discuss this all later. Other comprehensive income, statement of changes in equity, we will solve sums and we will do workings on it. Just know the theory as of now. Most commonly used format: vertical format, horizontal format. And then we are coming to cash flow. Cash flow we will study later. Cash flow is a other concept, is a separate concept. We need a separate class we will solve. So now let's solve some MCQ.